to self-constructed assets. So now we're going to get into this discussion of interest capitalization. Okay. So we have this problem, again, we're constructing an asset, and I've sort of started discussing this already in the context of one of the problems we did. But sometimes you are constructing an asset, and you have to figure out what are the costs of constructing that asset. So the first issue, which both of these issues have come up, which is great because it just shows you guys are thinking ahead. So how much in terms of manufacturing costs should be allocated to the construction? So, and really we're talking about indirect costs here. So how much overhead should be allocated to that construction? That's the first question. So if I'm constructing a property and I am sitting doing the accounting for that property in an office where we pay rent on a monthly basis, okay, is that rent different regardless of whether or not we're constructing that building? I'm still sitting there, but some of my time is now being spent dealing with the accounting for this construction process. Okay, so this is one of the issues. There are like these fixed overhead costs that are incurred regardless of whether or not you're constructing that asset, but yet I'm spending my time getting that asset ready for its use by doing the work that I'm doing in that office, so I may be paying rent. Okay? There are other things where you may have overhead costs where you have electric. Okay? Electric is your electric bill going to go up if you're constructing an asset and you're plugging in more equipment to construct that asset? But that electric bill, so it is going to go up, right? Because you are constructing an asset. But you may have an electric bill that's also for your office space and all sorts of things. So you have these costs that incrementally go up that are overhead, like power. And then you have costs that are fixed, like my salary or the rent for the space that I sit in doing the accounting work that I do. So the question is, when you're constructing an asset, some of those costs really are related to constructing that asset because power is going up and some of my time is being spent doing the accounting. Okay? So the first issue is how much should we allocate to construction? Okay, this is the first issue. The second issue is how should we treat interest during construction, interest costs incurred during construction. Okay? So these are the two issues when you're trying to figure out how much an asset costs you to construct. These are the two issues that come about, okay? Because there are basic things. What happens is companies construct assets, and what they often do is they take out loans to construct these assets. And what happens is what we're used to seeing in our our daily lives, so to speak. So you may think, I want to buy a house in the future, and I want to take out a loan. I'm going to use that loan to buy that house. What companies often do that are constructing assets is they take out loans from a bank initially to purchase a property, and then what they do is they take out what are called loan draws. Okay, so they may say, I need $12 million to buy this property, but the loan may go up to $100 million. Okay, and every month you construct that asset, and every month you take the bills that you get from the contractors, and you submit them to the bank, and the bank gives you a big check, and then you pay your bills. Okay, and so your loan goes up over time. Okay, those costs. The basic costs, the bills that you get from the contractor are very simple. Those increase the price of that property, of constructing that asset, okay? But then you have other things like people's time being spent that are not necessarily going directly through the loan draw, okay? And you have like power bills and things like that. These also may need to be incorporated into the price of that asset. Does that make sense? So you have direct bills that you submit to, say, the lender to get, a check for, to then repay the contractors, but then you have these other things, okay? And then as you incur those costs, as you take out loan draws, what happens to your loan balance? It goes up, and therefore what happens to your monthly loan interest payment? Goes up, okay? So the question is, how do you account for the interest related to those increased loan payments? Okay?